All right, today we're going to dig into a company that's been making some serious waves for income investors, Fidus Investment, ticker symbol FDUS. And the reason for all the chatter? Well, it's a yield that's pretty much impossible to look away from.
Yup, you're seeing that right, an 11.3% forward dividend yield. I mean, come on, in today's world, a number like that just screams for your attention. It forces you to stop and wonder.
Is this the real deal? A fantastic chance to lock in a huge income stream? Or is it a classic trap? A warning sign of some serious trouble hiding just under the surface? That's exactly what we're here to get to the bottom of.
Now, you and I both know the old saying, if it looks too good to be true, it probably is. Double-digit yields almost always come with a catch. They usually mean you're taking on a ton of risk. But is that always the case? This quote really hits the nail on the head. It's that tension, right? High risk is the default assumption. But that word sometimes, that's where things get interesting. Sometimes there's a genuine opportunity there for those willing to do the homework. So our job is to figure out which one Fidus is. Okay, so before we can even start to analyze that yield, we've got to pop the hood and see what's powering this thing. Who exactly is Fidus Investment, and what is it they actually do? Fidus is what's called a business development company, or a BDC for short. And this is a really important point to get. A BDC isn't like a mutual fund that just buys and sells stocks. No, it's more like a mini investment bank. They actively loan money and buy stakes in smaller private companies. You know, the kinds of businesses that are too small to get a loan from a giant faceless bank. And Fidus has its own special playground, the lower middle market. We're talking about established companies that need cash to expand, buy a competitor, or just reorganize. Fidus comes in and acts as their financial partner, giving them loans and sometimes even buying a piece of the company. And make no mistake, this isn't some tiny operation. A quick peek at their recent numbers shows a company managing a portfolio with nearly $700 million. In a single quarter, they pulled in $40 million in income and netted over $18 million in profit. So bottom line, this is a substantial money-making business.
Okay, so we know who Fidus is. Now let's look at the bull case, the exciting part. How in the world does a company like this generate enough cash to pay out that massive dividend?
It really boils down to three main engines. First, and this is the big one, they collect interest on the loans they make. And since they're lending to smaller, riskier companies, they get to charge much higher interest rates. Second, they often get a piece of the action, an equity stake, which can turn into a huge home run if that company gets sold or goes public. And third, they collect fees just for putting these complicated deals together. So the whole argument for why this yield might be for real rests on these strengths. They're experts in their niche, which gives them power. Their recent profits show the business model is working. They have multiple ways to make money on each deal. And let's be honest, in a world where it's hard to find decent yield, investors are lining up for an income stream like this. But you knew there had to be a but, right? It can't all be sunshine and roses. With a yield this big, there's always a catch. So let's flip the coin and talk about the potential landmines, the bear case. And here it is. This is probably the single biggest red flag staring us in the face, the payout ratio. What this means is that for every dollar of profit they make, Fidus is paying out over 98 cents of it in dividends. That leaves them with a cushion of, well, almost nothing. The margin for error here is razor thin. And that tiny cushion makes every other risk so much more dangerous. You've got the most obvious one, credit risk. What happens if the companies they lent money to start going out of business? With that payout ratio, even a small hiccup in their income could mean they can't afford the dividend. Plus, these types of companies get hammered during recessions, and their investments aren't like stocks you can sell in a second. So let's play out the nightmare scenario. A recession hits, a few of their portfolio companies default, and Fidus has to cut that juicy dividend. What happens next? All the investors who bought it for the yield, they run for the exits. The stock price tanks, and suddenly you've lost way more in principal than you ever made in dividends.
So we've seen the bright side and we've stared into the abyss of the downside. That leaves us with the big question. What do you do? Well, the decision is obviously yours, but let's walk through a simple framework to help you think it through.
You can really break it down into three camps. This might be a buy for you, but only if you have a strong stomach for volatility, you're committed to watching it like a hawk, and you keep it as a very small part of your overall portfolio. It could be a hold if you already own it and you still have faith in the management, but for anyone who's risk-averse, it's probably a clear pass.
And hey, if you do decide to jump in, this is not a set-it-and-forget-it investment. This becomes your homework.
Every quarter, you've got to be checking on these things. Are more loans going bad? Is the company's net value holding up? And the big one, are they still earning enough to cover that dividend? You basically have to become a mini analyst.
If there's one thing to take away from all this, it's this. Fidus is not a replacement for your safe, boring investments. Think of your portfolio like a dinner plate. This isn't the steak or the potatoes. This is the little bit of extra spicy hot sauce you put on the side. It's a speculative play, period.
Which brings us right back to where we started. But now the question is for you. Knowing the risks, seeing that razor-thin margin for error, and understanding the constant homework required, is that 11.3% yield worth all that vigilance? That's the trade-off. And it's a decision only you can make for your own portfolio.